Accounting principles. What are they and how GAAP and IFRS work? If you'd like to hear about this, stick around. Have you ever wondered how companies in different countries all prepare financial reports in a way investors can actually understand? Because without a common set of rules, every company could report profits differently and financial statements would become chaos. That's where our accounting principles come in. Accounting principles are the fundamental rules and guidelines businesses follow when recording and reporting financial information. In simple terms, they are a foundation that keeps accounting consistent, honest, and comparable. Think of them as the universal grammar of financial reporting. The principles cover things like consistency, accuracy, and full disclosure, matching income with expenses, and recording transactions in the correct period. Without these principles, one company could make itself look richer by changing how it records things. Now, over time, two major accounting frameworks became dominant in the world. The first one is GAAP, which stands for Generally Accepted Accounting Principles. This is mainly used in the United States and maintained by the Financial Accounting Standards Board, or FASB. The second is IFRS, which stands for International Financial Reporting Standards. These are developed by International Accounting Standards and Standards Board and are used widely across international markets. Think about Americans, they want to be special. They are special, aren't they? Special needs. Now here's the big difference. GAAP is generally much more rules focused. It gives companies very detailed instructions for many accounting situations. The IFRS is more principles focused. It gives broader guidance and expects accountants to apply professional judgment depending on the situation. Let's make that simple. Imagine two drivers. GAAP gives you GPS. Let me try that again. GAAP gives you detailed GPS with exact turn-by-turn instructions, and the other one, IFRS, gives you destination and the road rules, but expect you to make smart decisions along the way. Both get you there, but in different styles. So why these systems matter? Because investors, banks, governments, and business owners rely on financial statements to make major decisions. They need confidence that numbers are prepared under trusted principles, not made up of however the company feels like. These accounting principles make reports transparent, comparable, and harder to manipulate. Now, despite their differences, GAAP and IFRS are trying to achieve the same goal: accurate and reliable financial reporting. In fact, the two boards have spent years trying to reduce major differences between them to improve global comparability. Common misunderstanding is thinking GAAP and IFRS are completely opposite systems. They are not. They share many of the same accounting ideas. The main difference is how detailed the guidance is. Another misconception is that accounting principles are technical rules for accountants. In reality, these principles share how every company's profits, assets, and financial health are presented to the world. So, what's the key takeaway, you ask? Well, I'll tell you even if you don't want to know because you've lasted this long. Accounting principles are the core rules that keep financial reporting accurate and consistent. GAAP and IFRS are two major global frameworks built on those principles, one more detailed, one more flexible, but both designed to make the financial statements trustworthy. And once you understand that, you realize accounting isn't just numbers on paper, it's language built on rules, and financial world depends on it, on them, or one of them. Since you've lasted this long, how about subscribe? Because apparently you like what you see. Maybe my face, but more of the information. Thanks. Bye.